In addition to that, the increase in interest rates reflects concerns about inflation, which are positive for gold prices.
Because higher inflation, of course, is going to drive gold prices higher. It's going to give it bullish undertones, and the market sentiment will shift.
Okay, so let's start with macro news first and foremost, and then we'll get into some of the more academic discussions, shall we say. The Federal Reserve is slated for a 50 basis point hike in the next meeting. At least that is the consensus estimate. Do you agree with the consensus estimate? Let's start with you, Jeff.
It's most likely that they will do that because that's what they've been signaling. And I think that they would rather stick with their signals than give a strange message by changing their tune. So yeah, we're looking for a 50 basis point increase in the middle of June.
Okay, and Gary?
I agree. I believe that what the Fed wants to do is have some kind of sense that what they say is what they will do. They talked about taking a 3/4 or 75 basis point rate hike off the table, but they've talked about leaving it open-ended. In other words, I believe that the Fed will continue to raise rates by 0.5% or 50 basis points for the next couple of FOMC meetings if they believe that inflation is not really ticking down and they're not really seeing any kind of major change.
Okay. This comes as the Bank of Canada today on Wednesday raised their interest rate, their benchmark rate to 1.5% in line with most analysts' expectations. Now, Jeff, let's start with you. It seems like central banks around the world are tightening. It's not just the U.S. Fed. The Bank of Canada, for example, like I just said, the gold market did not respond negatively today to the Bank of Canada's decision. Gold is somewhat flat, slightly in the green. But the point is, you would expect higher interest rates to really weigh down on gold. We've been trading in this range of $1,800 to $1,900 an ounce for quite some time. I mean, it's not strong by historical standards in the sense that we had seen higher gold prices earlier in the year. But given that interest rates are rising, some might say faster than expected, one might speculate that gold should be trading even lower. So how would you characterize gold's reaction so far to the interest rate hikes that we've been seeing all around the world? Jeff?
I'm not surprised that gold hasn't overreacted. I mean, if you had asked me before, I think that there is an undue fear of rising interest rates, not only in the gold market, but in the broader financial markets. I mean, you have to put into context what the past 50 basis point move by the Fed means, what the future 50 basis point move and subsequent ones are, and what the Bank of Canada does. I mean, you still have historically low interest rates. We've moved off of the bottom from 25 bips to 1.1% for 90-day T-bills, but we have very low nominal rates. We have a long way to go before you start seeing those interest rates putting a brake on demand. And we'll probably talk later about the supply side of the economy and fiscal policy. Yes. And you also have negative interest rates in an inflation-adjusted basis. So from a perspective of the effects of the interest rate increases on gold prices, I wouldn't expect a major negative impact on gold prices. In addition to that, the increase in interest rates reflects concerns about inflation, which are positive for gold prices, and the increase in interest rates and the high inflation and the whole mashugala that goes together that's causing the interest rates to rise is generally characterized as volatility and uncertainty about the economic environment. And in that kind of environment, people turn toward gold. So the rising interest rates, you can argue, actually are positive for gold. And then when you look at the historical correlation, 1968 to the present, the correlation between T-bills and gold is zero. I mean, there are periods of time when they're both rising, there are periods of time when they're moving in opposite directions, and there are periods of times when they're both falling. So I think there's an overemphasis on interest rates based on the historical relationship between interest rates and gold and where interest rates actually are today.
Okay. Gary, I'd like you to respond, please. And of course, talk about your research and what you have found over your many years of research on the gold market. The relationship between gold and interest rates, what is it?
Well, first of all, the first thing that I do want to discuss that is noteworthy is the fact that we have a pendulum swinging in terms of market sentiment, because higher inflation, of course, is going to drive gold prices higher. It's going to give it bullish undertones, and the market sentiment will shift. However, when the Federal Reserve comes in and addresses that by raising rates, that has a negative impact. The other thing that I find is absolutely noteworthy is, beside raising rates, we not only tapered the asset purchases, the Federal Reserve, but they are now liquidating parts of their asset sheet and reducing their balance sheet. And that has the same net effect as raising rates. So while they might raise rates by 50 basis points at the next FOMC meeting, each and every month, they are letting their mortgage-backed securities as well as their treasuries just come to fruition, and they're not re-upping them, so to speak. In other words, they're reducing their balance sheet. So you've got both of those putting a strong effect on the demand side, because it's more expensive to do business, it's more expensive for goods. The other thing that is very important to me is that market sentiment, as I said, keeps shifting back and forth, where you will see that on some days investors are real concerned about the rate of inflation, other days the rate of interest rates. And that seems to swing back and forth, and that's what's giving us our volatility.